Marginal tax brackets, effective tax rate. You may have heard these words thrown around before, but do you know what they actually mean? The first step in reducing your family's taxes is knowing how the system works. First, let's talk about marginal tax brackets, which is how federal income taxes are calculated in the US. Let's say your income is $150,000. You would fall right here in the 24% bracket. It might seem like if you're in the 24% bracket, all of your income would be taxed at that 24% rate, but that's simply not true. It might help if you think of brackets as buckets instead. You fill each bucket one at a time with your income before you move on to the next. Let's break down exactly how this works, starting with the first bucket, and that's my favorite one, 0%. Each year, the government lets you exclude a certain amount of your income before calculating your taxes, otherwise known as the standard deduction. Anything that falls into this bucket is not taxed at all. For a single taxpayer, the standard deduction in 2026 is $16,100. If you have significant deductible expenses, such as mortgage interest, charitable gifts, or a large amount of state taxes, your 0% bucket could even be larger than the standard deduction if you itemize your deductions. Assuming there's no reason for you to itemize your deductions, let's take $16,100 of your income and fill the 0% bucket. Now you're left with $133,900. So where does the rest go? It starts spilling over into the next bucket, the 10% bucket. The 10% bucket has room for $12,400. So only that much of the $133,900 that needs to be taxed will fit in this bucket, and the rest will spill over into the next bucket and beyond until your last dollar is placed in a bucket. If you add up your total taxes in this example, your tax bill would be $24,734. And if we take that number and divide it by your total income of $150,000, you would get your average tax rate, which is also called your effective tax rate. The effective tax rate in this case is a little over 16% of your income, not 24%. Keep in mind, we're oversimplifying your hypothetical tax situation and also ignoring state income taxes in this example. Here's why it's so important to understand these concepts. Say we're able to lower your taxable income by $10,000, do you think the tax savings would be at 16% or at 24%? The answer is 24%. That $10,000 would come out of the highest income tax bucket first. For every dollar you take away of your taxable income, you save taxes at your top tax rate, not your effective tax rate. In this case, that's a tax savings of 24 cents for every dollar of income reduction, i.e., $2,400. Now that might not sound like a lot, but in general, the greater your income, the greater your income tax savings could be from smart tax planning. And that's why understanding these buckets or brackets, whatever you want to call them, is so powerful for families looking to build lasting wealth. Thanks for watching.